All right, we're now broadcasting to all attendees when we are recording.
We're recording now.
All right, welcome everybody to the 5 Tips for First-Time Homebuyers webinar. I'm Chris Giolito with William Ravis. I'm going to share my screen here with you guys all in a moment. Right now, hold on. And let's jump right in. All right, so as I said, 5 tips for first-time homebuyers seminar. A little bit about me first. Again, my name is Chris Giolito with William Ravis Real Estate. And this is my contact info on the left. If you have any questions, you can follow me on social. I try to keep it as interesting as possible. A little bit about me. I've been I am a member of the Hanson Balistreri Realty Group within William Ravis. We are the #1 selling group in Norwalk in 2018 and 2019. I graduated from Norwalk High School in 2005. I graduated from UConn in 2009. I'm an avid golfer. I'm a Yankees fan, a Jets fan, and a Rangers fan, and I get a lot of flack for that combination. And I'm getting married in June of 2021. So I want to start off by debunking some of the myths of today's market. There's a lot of, I don't want to say false information going around, but there's a lot of clickbait. So let's dive right in. Myth number 1, it's 2008 all over again. This is everybody's greatest fear, that our economy is going to get back to a time around 2008 when the housing market crashed, the banks crashed, and we needed to bail everybody out. So let's look into that a little bit more. If you look at all the banks, they've done a lot of historical research and have taken into account what's going on with the economy, what was happening beforehand, and a lot of them are expecting a V-shaped recovery, shown by the graph on the right. And this is because banks are financially stable and they do not need a bailout. Unlike 2008, we don't have a housing bubble. The housing market is very stable due to many of the restrictions that were enabled post-2008. And if you think about it, there was no threat to the economy before COVID-19. And it's important to remember that this is a downturn caused by a health crisis and not an economic crisis. So yes, we are in some economic trouble right now, but it's all being caused by a health scare, not by problems within the economy. And if you look at the Harvard Business Review, they're just speaking about here the type of recoveries that we've seen in past pandemics. And hopefully this remains true. They have all been V-shaped so far. Myth number 2, I hear this a lot. Housing prices will fall, right? The economy is going down, so that automatically means that house prices are going to fall. And again, this really stems back to 2008 when housing prices dropped close to 20%. If you actually look at what economists are predicting, they're actually predicting housing prices to appreciate. You can see here in the blue, this is what they were expected to appreciate pre-COVID, and in the green, now that we're going through this is the readjustment of those percentages. Homes are still expected to appreciate value. And this is happening because the interest rates are at all-time lows. And if you think about it like this, when interest rates are low, buyers can afford to pay more for homes because they're paying less in interest. 3 out of the last 4 recessions, excluding 2008, have seen homes appreciate in value. So let's just look at that in this image here. You can see in 1980, 1981, and in 2001, home prices actually appreciated. Now, again, we're excluding 2008 because much of that was caused by the housing market at the time. And the lone real outlier is really just 1991. Myth number three, I can't get a mortgage. Many people right now believe that with what's going on, that there's so many restrictions that they won't be able to get a mortgage. Lenders certainly have tightened during during the pandemic, and Kristen can talk more about that. However, mortgages are still being written. In fact, the two of us are actually working together on a loan currently to close at the end of May. So this is false. And yes, is it a little more difficult right now to get a mortgage, say, than it was a couple months ago? Yes, but mortgages are still being written and people are buying homes. So let's jump into the 5 tips for buying your first home. Number 1, know what you can afford as a down payment. So we all know that we need to save, right? How much money do you need to have saved? And that depends on a lot of things. You also need to realize you need to have money saved for closing costs, inspection, and then in the future for home repairs, furniture, and more. But certainly for closing costs and inspection. This is the most important. You do not need 20% down payment to purchase a home. Many first-time home buyers believe that they need 20%, and that's not true. You can work with a mortgage professional to look at all of your mortgage options and determine which loan structure works best for you. And you can put down as little as 3%. That's very important to know because many people, as I said, believe you need the 20% down. And when they realize they need only 3%, they say things to me like, I have 5%, I have 6%, I have 10. And then they can really get the ball kind of moving on their first home. Tip number 2 is get pre-approved for a mortgage. What this does, it allows you to understand what you can afford. A big part of this is understanding what your monthly payments are going to be so that you can be comfortable in what you're paying every month for your home. As I said, decide what you're comfortable paying. And then it really helps define the search criteria. If you thought you could afford a home up to $600,000, but you're really only comfortable paying for a house that's only up to $500,000, you're not wasting your time seeing these bigger, nicer homes that you wish you could afford and no longer can. Tip number 3 is stick to your predetermined budget. This is so important. You don't want to be house poor. And so I had this conversation with a client a couple weeks ago. Kind of works for the slide before too. They were talking about seeing homes up to $650,000. And when they found out what those payments monthly were going to be, he realized that that's not what they wanted to spend, that they would then be house poor. And I explained it to him as, all those times you like to go to the bars on Sundays to watch college football or NFL football, like probably not happening anymore, or at least for the foreseeable future. Sticking to your predetermined budget can also help you be mindful of times of financial hardship, like many of us are in right now. So when economies are in recessions and things like that, you're still okay. You can still afford to pay your mortgage and keep your home. This is a very emotional decision, especially when buying your first home. So if you can stick to your predetermined budget, you can almost promise yourself you're not going to put yourself in a position where you're paying for more home than you can actually afford. And so do your best to balance between the emotional approach and a approach that's based on it's an emotional approach versus a money approach. So it's such an emotional time for you buying this home. just keep in mind of what you want to pay so you can make the best decision for you and your family moving forward. Number 4 is keep an open mind and prioritize your criteria. So your first home, it's important to know that your first home most likely will not be your last home. Yes, this is your first home. You're excited, but as your family grows, you'll probably need more space. You can potentially afford, or you're probably going to want another home. Let go of your HGTV expectations. This is important because, if you're like me, you love watching the shows and you see the beautiful homes and the finished product. Every home has problems. Even homes that are brand new constructions, inspectors will find problems. Many times the sellers are unwilling to fix some of these smaller ones. So it's just important to go in with the right expectation. Assign levels of importance to your criteria. So you may say you want 3 bedrooms, 2 baths, a 2-car garage, be in this town, in this size home with a backyard. Determine what's really most important to you, so that, because you're going to have to make concessions to what you would like in a home. And so really prioritizing it helps us find you the home that best fits you. And be open to compromising on many areas on your wish list. Tip 5. This is probably the best tip that I have, and it works. Write a letter to the homeowner. So you found a home that you love, you really want it, you don't want to lose it. Create a connection by writing a letter. If you think about it, people are much willing to, or are much more willing to work with another person when they feel a connection to them. And it can often be the tiebreaker against other offers. I have a friend who was looking for a home for months, and she wrote a letter to the owners of a house that she put an offer in on. There were 14 other offers, and hers was not the highest price, but she got the house because she wrote a letter that connected with the homeowners. And do this by telling the story of what this new home will mean to you and your family. And add a photo. Again, we want to make this as personal as we can. You want them to feel like they know you. So to wrap that up, it's okay to not know it's okay to not know everything when you are buying your first home. That's what we're here for. That's why we want to help. Again, if you'd like to contact me with any other questions, my email is down on the left there, chrisgiolito@com. My cell phone is there on the right. You can text me, you can call me. Happy to walk you through any questions you have. I'm going to stop my share now and send it over to Kristen. She is going to talk to you all about mortgage.
Oh no, I lost you. Where are you? Okay, there you are. So my slides are not as fancy. Let's see.
There we are.
All right. I have to start this from the top. Hold on. And then, is there a way to play it? I think I can play, right?
Yeah, see the little
slideshow.
Yep, there you go.
From beginning.
Perfect.
Oh boy. Okay, what do I do now to get through this?
Just tap.
Okay.
Yep.
How do I go back now?
The left arrow button.
Hold on. Yeah, technology is not my thing. Why is it not going back to the beginning? Okay, there we go. And then I just click it to go next. Okay.
Yep.
So that was great. You went over a lot of it, which is nice. So I'm not going to talk about really the realtor end because you, Chris, you just did that. But the benefits, I think what I want to start with are the benefits of buying versus renting. It's definitely something important to talk about because I know, and especially where we are, there's a lot of people looking to rent. thinking they can't buy because they don't really understand that you don't have to put 20% down, all of the myths that you had there. I'll talk about those as well. Benefits of getting a pre-approval, and I'll talk about a little bit about the difference between pre-qualification versus pre-approval versus the certified pre-approval that we do at Revis. And the low down payment loans are, something that are, everybody needs to know. How does the process work? Well, you, like Chris said, identify your criteria. You can view properties, make an offer, home inspection, purchase, sale, financing, and then close. There are a lot of steps in between all of that and getting to all those steps. How to determine, importance of a buyer's agent. This is Chris. It helps determine your needs, and you're, legally bound to represent buyer's interest exclusively, protecting and advocating for your interest. This is really important. I did work with a buyer just recently who was not represented by an agent, and it was very difficult for him. He did not have anybody to represent him in any negotiations. He, really didn't understand seller credits and all the things that the agent and I talk about to get closing costs covered in the loan. That's something that we can talk about too. There's a lot of ways to finance closing costs. So you don't have to come out of pocket with them, which is, again, goes with the lower, down payment, lower cash to close. Anyway, super important to have a buyer's agent. They keep the process moving. They help you identify, attorneys, inspectors. They can guide you to, somebody to do financing, which Chris and I work well together. We work through Revis. We are a team. We have a team of people working for us, and it's nice to be all in the same place, working towards the same goal. They will schedule a home inspection, which is important too, because a lot of times some things are wrong with the house that you don't know about, and you really need to know what exactly you're getting into. Keeping all parties informed. Sorry about that. Went ahead of myself there. Making sure buyers have mortgage commitment dates and closing dates is the other thing. All right. So here's what I do when Chris has a client, and getting a pre-approval at this point, especially during COVID, it's important to have a pre-approval. A lot of agents and sellers do not want people in their houses that are just looking. They want to make sure they are absolutely qualified before letting somebody in their house. So what I do is I will look at your 2-year history of employment. It doesn't have to be the same job. It doesn't have to be an education count. So if you're a nurse for a year and you were in school the year before, that counts as a 2-year history of employment. So we can use that. And that will determine your debt to income ratio, which is how we determine what loans you're qualified for, how much money you need to put down, that kind of thing. Credit in a normal situation, we can do as low as 580. But right now with COVID, they're really they've moved those numbers up to about 620, 640, 700, depending on the loan product. My hope is that we'll go back to the 580. We'll be able to do that eventually. And then your assets, eligible versus ineligible sources of funds, money that you can and cannot use. So pre-qualification is verbal, plus we run your credit. And you tell me how much money you make, I put it into my system. You tell me how much money you want to put down. And I just believe that's what you have and what you make for a month, per month or year. And then pull your credit, look through your liabilities, and I will send a pre-qualification. I don't do that normally. And then the pre-approval is verbal plus credit, plus we do an automated underwriting. What we do is certified pre-approval, especially now. And I don't have any agents that are going out without this certified pre-approval at this point. I do all of the above, plus I get all the paperwork. So I'll have all the documents there for me to go over. I have a loan coordinator that I work side by side with, and we go through the loan and we make sure they're actually qualified, so that when you do go out, you're not risking somebody's, life with, getting sick if you're not, definitely qualified. And really, if you're not really looking to move at like right now, agents don't want to take time, to go out and not even take time, but they don't want to risk going out and taking people out and risk getting sick. Oh, what happened to this one? Oh, I guess it's doing it this way. So you can do as little as 3% down, like Chris said. So 3% is a Home Ready, Home Possible loan. That has an income limit that's attached to it. So if you were to come in and you wanted to buy a house in Norwalk and you found a house that you loved, and you make the income limit in Norwalk for most of the town is just over $96,000. So if you make under $96,000, which is the income limit there, you can do a 3% down payment. And the rates are significantly better. These Home Ready, Home Possible loans are just for lower income, lower down payment buyers. Gifts are okay for down payments. You can get a gift from a family member. FHA, it has to be a family member. For conventional, you can get a gift from somebody who is, you are affiliated with somehow, a friend, whatever, family members. So you have a gift, they give you the money, we have to source it, we have to have documentation to go along with it. So it's not just a matter of putting it in your bank account and saying, oh, here you go. Everything has to be documented, but it is okay to get a gift if you don't have the down payment yourself. So low down payment loans are available. There's also the FHA loan, which is a government funded loan, which is 3.5% down. So that's another one that we do. And that depends on a few different things that, as we go through the process and I get all your information, we'll determine what loan is going to work best for you. We'll compare loans. Like I said, determine what loan is best for you. You are in the driver's seat. It's your loan. It's your, money. And it's definitely up to you how you want to go about doing this. So this is buying versus renting, just a little bit of numbers here. $2,500 in rent per month. Chris would know better than me as far as what rentals are in Norwalk. But if you were to purchase, this is just an example of what you would pay. If you were to purchase a house for $425,000 at 3% down, a loan of $250,000 at 3%. That is I actually did this today. I quoted this purchase price loan amount with a 700 credit score and a debt to income ratio that I put in there too. And this was it was a 3% rate. It was a Home Ready, Home Possible loan. Now, if you're under that income limit, this may be too much. I'd have to run the whole, application to see if it would work with the numbers. But so it's $1,738 a month, principal and interest. Then you add in taxes. We made up the taxes, and condo fees if they're condo fees, insurance if there's homeowner's insurance if it's not a condo. Total payment of $2,321. And yes, it really is that. But again, when you take out, when you purchase a house, you are able to take the taxes and interest you pay on the loan, and you can write it off on your taxes. So you will get a tax benefit for having that, for having the house instead of paying a landlord this more money and it not being invested for you. So this is the 3% appreciation. If it were to appreciate 3%, 400 times 425,000 is 12,750 annually. And you invested $20,000 into that. So that was how much you put down, closing costs, whatever, 3% down plus closing costs. So basically what it is, if the house appreciates in 3 years, it's $465,000 and now you've earned $40,000. So it's an investment for you in your future. And this is, if you have any questions or anything, if you want to reach out to me, my phone number, my email is kristenpolisic@ravis.com, same as Chris's. And that's it. I think that's all I have for you.
Awesome. Thank you, Kristen. Coming back in here. Great. So we want to thank everybody for joining. And again, if you have any questions at all, please feel reach out to us. We're happy to answer anything. No question is too small. Yeah, I mean, I call her all the time to ask all kinds of questions because no deal is ever the same. So again, we appreciate you all being here, and hopefully we get to talk to you in the future. Thank you.
Thank you.